What if I told you that the reason you have not started investing yet has nothing to do with money? What if the real reason is something nobody ever told you, something hidden in the way you were raised, the way you think, and the way you see yourself? Right now, while you're reading this, people with no degree, no savings account, and no financial background are building real wealth, not because they got lucky, not because they found a secret, but because they finally understood something simple that most people never do. And in the next few minutes, I am going to show you exactly what that is. This is not a motivational speech. This is a step-by-step look at how regular people start from nothing and change everything. Stay with me because what comes next might be the most important thing you hear all year. Before we go any further, I want to ask you something. If this video helps you even a little bit, if it opens your eyes to something you did not know before, hit that subscribe button right now and drop a comment below telling me where you are starting from. Write the words "starting from zero" in the comments. I read every single one, and your comment might be the thing that keeps someone else going today. Now let us get into it. Most people believe that investing is only for people who already have money. They think you need thousands of dollars, a stockbroker in a nice suit, or some kind of special access that regular people just do not have. But that belief is wrong, and it is costing you every single day. The truth is that the investing world has changed completely in the last few years. The barriers that used to exist are gone. The tools are free. The information is everywhere. And the minimum amount you need to start is smaller than most people spend on coffee in a week. The problem is not access. The problem is that nobody sat down and explained it in plain language. That is what this video is here to do. Think about what it means to wait. Every year you do not invest, inflation is eating your money from the inside. The dollars sitting in your checking account today are worth less tomorrow than they are worth right now. That is not a theory. That is how money works in the modern world. While your savings lose value by just sitting there, the people who invested even a small amount years ago are watching their money grow. The gap between people who invest and people who do not is not just about money, it is about time. And every day you wait, that gap gets a little bit wider. This is the part most financial videos skip over because it makes people uncomfortable. But you need to hear it. Here is the most important thing you need to understand before we go any further. You do not need to be rich to start investing. You need to start investing to become financially stable. Those two things are completely different, and confusing them is why so many people never begin. The journey starts before you have money saved. It starts with a decision, a small action, and a habit. Once you understand that, everything else becomes a lot more clear. Let us talk about exactly how to do that from nothing. The first thing holding most people back is not their bank account, it is their mindset about money. From the time we were kids, most of us were taught that money is hard to get, easy to lose, and not something people like us should expect to have a lot of. Those ideas go deep, they sit in the back of your mind, and they shape every decision you make without you even knowing it. When an opportunity shows up, the mindset says it is too risky. When you get a raise, the mindset says spend it before it disappears. When someone talks about investing, the mindset says that is for other people. You have to recognize that voice before you can change anything. The research on money psychology is clear. People do not make financial decisions based on logic alone. They make them based on emotion, fear, and the stories they were told growing up. A person who grew up watching their parents stress about bills every month will carry that stress into adulthood even when their own situation is completely different. A person who was told that rich people are greedy or dishonest will find ways, even unconsciously, to avoid becoming wealthy. These patterns are not character flaws, they are learned responses, and learned responses can be unlearned. That is the good news. Start paying attention to the stories you tell yourself about money. When you think about investing, what comes up? Do you feel excited? Do you feel scared? Do you feel like it is not meant for you? Those feelings are data. They tell you where the work needs to happen first. You cannot build a strong financial future on a weak foundation. And the foundation is not a bank account. The foundation is your relationship with the idea of having money in the first place. Once you start to clean that up, decisions become easier. Actions start to feel possible instead of out of reach. One of the most powerful shifts you can make is to stop seeing money as something you chase and start seeing it as something you manage. Chasing money means you are always running. You take a second job, you work longer hours, you burn out. Managing money means you make intentional decisions with what you already have, even if it is a small amount. You stop leaking it through small habits that do not serve you. You start directing it toward things that grow. The person who manages $50 well is already ahead of the person who earns $5,000 and spends every cent of it without thinking. Here is a simple exercise that changed how a lot of people see their finances. Write down every dollar you spent last month. Not to judge yourself, not to feel bad, just to see. Most people are shocked when they look at the numbers, not because they spent a lot on big things, but because they spent a lot on small things they cannot even remember. That awareness is the beginning of control, and control is the beginning of freedom. You cannot invest what you do not have, but you can often find what you need to start by simply paying attention to where it is already going. Now let us talk about what investing actually is, because a lot of people have a fuzzy idea of it that does not help them. Investing is putting your money into something that has the potential to grow over time. That is it. It does not have to involve the stock market. It does not have to involve a financial advisor. It does not have to involve anything complicated at all. When you buy a book that teaches you a skill that earns you more money, that is an investment. When you put $20 into an index fund and leave it there for 10 years, that is an investment. The idea is simple. You give something now to get more back later. The most common form of investing that regular people start with today is putting money into the stock market through low-cost index funds. An index fund is basically a basket of stocks that tracks the performance of a large group of companies. Instead of picking one company to bet on, you are spreading your money across hundreds of companies at once. This is called diversification, and it reduces your risk significantly. Historically, broad market index funds have grown at an average of around 7 to 10% per year over long periods. That might not sound like a lot, but when you understand compound growth, those numbers become extraordinary. Compound growth means your money earns returns, and then those returns also earn returns. Over time, this creates a snowball effect. If you invest $100 a month starting today and leave it alone for 30 years at an average of 8% annual growth, you will end up with well over $100,000. That is from $100 a month. Not a giant salary, not a lucky break, just consistency and time. The earlier you start, the more powerful this becomes. And the people who waited until they felt ready often end up looking back and wishing they had started sooner. There is something called the Rule of 72 that investors use to understand how quickly their money can double. You divide 72 by the annual interest rate your investment earns. So at 8% growth, your money doubles roughly every 9 years. At 10%, every 7 years. This is why starting early matters so much. A person who starts at 25 and invests consistently will have dramatically more money at 65 than someone who starts at 35 with the same monthly amount. Those 10 years at the beginning are not just 10 years. They are multiple doubling cycles that the late starter never gets back. Understanding the basics of how money grows through investing is not complicated, but it is rarely taught in schools, and most families never talk about it directly, so people grow up thinking it is mysterious or dangerous or only for a certain type of person. It is none of those things. It is a skill, and like any skill, it gets easier the more you practice it. You do not need to understand everything before you start. You need to understand enough to take the first step, and the first step is smaller than you think. Let us talk about where you actually put your money when you are starting from nothing. The good news is that today there are platforms that allow you to open an investment account with as little as $1. These are called brokerage accounts, and many of the best ones have zero fees for basic investing. You do not need a minimum balance. You do not need a financial advisor to hold your hand. You just need a phone, a bank account, and a few minutes to sign up. Once your account is open, you can start buying fractional shares of index funds. That means you can own a tiny piece of a large fund even if you only have $5 or $10 to start with. The most important thing when choosing where to invest is to keep costs low. Some investment products come with high fees that quietly eat away at your returns over time. A difference of 1 or 2% in fees might not sound like much, but over decades it can cost you tens of thousands of dollars in lost growth. This is why most financial experts who are not trying to sell you something recommend simple, low-cost index funds over actively managed funds. The evidence consistently shows that most actively managed funds do not outperform the market over the long term. The simple approach wins more often than not. When you are just starting, you do not need to pick individual stocks. You do not need to predict which companies will do well. You just need to put money into a broad market fund regularly and leave it alone. This is called passive investing, and it is the strategy that the world's most respected investors recommend for regular people. The legendary investor Warren Buffett has said publicly that the best investment for most people is a low-cost index fund, not because it is exciting, but because it works. Excitement in investing usually leads to bad decisions. Boring, consistent, patient investing leads to wealth. One thing that trips up new investors is the fear of bad timing. People worry that they will invest right before the market drops and lose everything. This fear keeps them waiting for the perfect moment that never comes. The truth is that timing the market consistently is something that even professional investors fail to do. What matters much more than when you invest is that you invest regularly over a long period of time. This strategy is called dollar cost averaging. You put in a fixed amount every month no matter what the market is doing. When prices are high, you buy less. When prices are low, you buy more. Over time, this smooths out the risk. The market will go up and down. That is guaranteed. There will be years when your portfolio loses value on paper. But if you do not sell, those losses are not real. They are just numbers on a screen. The people who panic and sell during a downturn lock in their losses and miss the recovery. The people who stay invested and keep contributing through the hard times are the ones who come out ahead. This requires patience and a clear understanding of why you are investing in the first place. Write down your goal. Keep it visible. When the market drops and the news gets scary, that goal is what keeps you in the game. Now let us talk about the tools and habits that make starting from zero actually work in real life. Because the theory is one thing, but you are probably sitting there thinking about your actual bills, your actual income, and the actual gap between where you are and where you want to be. That is real, and it deserves a real answer. The first tool you need is a budget, but not a complicated one. You need to know three things: how much money comes in each month, how much goes out to things you cannot avoid, and how much is left over that you can redirect. Most people who say they have nothing left over at the end of the month have not actually looked at the numbers carefully. When they do, they usually find at least $20 to $50 per month that is going somewhere that does not serve their future. Subscription services they forgot about, small purchases that add up faster than expected, food that gets thrown away. None of these things are meant to make you feel guilty. They are just places where money is leaking out. And plugging even one or two of those leaks can create enough of a start to begin investing. You do not need a lot, you need consistency. The 50-30-20 rule is a simple budgeting framework that many people find helpful when they are starting out. 50% of your income goes to needs, 30% goes to wants, 20% goes to savings and investment. If 20% feels impossible right now, start with 5, or even 2. The point is not the percentage, the point is the habit. People who set aside even a small amount automatically before they spend anything else tend to grow their wealth over time because the habit becomes part of how they operate. Pay yourself first. That phrase sounds simple because it is. But most people do the opposite without even realizing it. Automation is one of the most powerful tools available to new investors. When you set up an automatic transfer from your checking account to your investment account on the day your paycheck arrives, investing stops being a decision and becomes a system. You never have to remember to do it. You never have to fight the temptation to spend it first. It just happens. And over time, you stop missing the money because your lifestyle adjusts to what is left. This is how people with modest incomes quietly build real wealth while their neighbors who earn more spend everything they make and wonder where it all went. The emotional side of budgeting and investing is real, and it deserves space. There will be months when something unexpected comes up and your investment has to wait. That is okay. Life is unpredictable. What matters is that you get back to the habit as soon as you can, and you do not use one missed month as a reason to stop altogether. Progress is not linear. People who succeed financially are not the ones who never have setbacks. They are the ones who keep showing up anyway. Every small action adds up. Every decision to stay in the game instead of quitting is a decision that competes on your behalf. One of the most overlooked starting points for investing is a retirement account. If your employer offers a retirement plan with any kind of matching contribution, that matching amount is essentially free money added to your investment. If the employer matches 50% of what you put in up to a certain amount and you do not take full advantage of that, you are leaving money on the table every single paycheck. This is one of the clearest financial wins available to working people, and it is underused. The account also comes with tax advantages that let your money grow faster than it would in a regular taxable account. Even if you do not have access to an employer plan, individual retirement accounts are available to almost anyone with earned income. The contribution limits are reasonable for someone just starting out, and the tax benefits can be significant over a long investment horizon. Traditional accounts give you a tax break now, reducing the amount of income you pay taxes on today. Other accounts let your money grow completely tax-free, meaning you pay no taxes on the gains when you eventually withdraw in retirement. Both options have advantages depending on your current income and your expectations for the future. The important thing is to start using one of these tools as early as possible. Taxes are something most beginning investors do not think about until it is too late. The way you hold your investments can make a large difference in how much you keep versus how much you pay the government. Keeping investments inside tax-advantaged accounts for as long as possible is one of the simplest and most effective ways to let compound growth work in your favor without interference. When you fully understand how these accounts work, the idea of not using them feels like paying full price for something that is available at a major discount. The education is free and the tools are accessible. The barrier is simply awareness. Beyond retirement accounts, there are other tax-advantaged tools designed for specific goals like education savings or healthcare costs. Each one offers a way to grow your money with less of it going to taxes. None of these are secret. They are available to anyone who looks for them. But because the financial industry tends to overcomplicate things, many people assume these tools are not for them. They are for you. They were created specifically to help regular people save and grow money over time. The people who use them consistently end up in a dramatically different financial position than the people who ignore them. The conversation about taxes and accounts might feel dry or complicated, but it connects directly to how much wealth you can actually build over time. Two people who invest the same amount of money over the same number of years can end up with completely different results based entirely on the accounts they used and the tax decisions they made. This is not about being a financial genius. It is about understanding the basic rules of the game you are playing and using them in your favor. The rules are public, the information is free. The only question is whether you are willing to learn them. Let us slow down for a moment and talk about risk, because this is the topic that scares people the most and also the one that gets explained poorly the most often. Risk in investing does not mean you will lose everything. It means different types of investments go up and down at different rates and at different times. Understanding risk means knowing what kind of ups and downs you can tolerate without making emotional decisions. because the biggest risk most investors face is not the market. It is themselves. It is the decision to sell when prices drop because fear won the argument against patience. There is something called risk tolerance, and it is different for every person. Someone who can watch their investment drop in value for a year without losing sleep has a high risk tolerance. Someone who checks their account every day and feels sick when the numbers are red has a lower tolerance. Neither is wrong. They just require different approaches. Knowing yourself honestly is more valuable than any investment strategy. If you are going to panic and sell during a downturn, owning a more aggressive portfolio is not going to help you. It will just hurt you faster. As a general rule, younger investors can take on more risk because they have more time to recover from downturns. Someone in their 20s investing for retirement decades away can hold a portfolio that is heavily weighted towards stocks, knowing that even a major market crash will likely be followed by a recovery long before they need to access the money. Someone closer to retirement needs a more conservative mix that protects what they have built while still growing slowly. This is called asset allocation, and adjusting it as you age is a standard and important part of long-term investing strategy. Diversification is the closest thing to a free lunch in investing. By spreading your money across many different types of assets, industries, and geographic regions, you reduce the impact that any single bad event can have on your total portfolio. If one sector crashes, the others may be fine or even going up. If one country's economy slows, another may be growing. A broadly diversified portfolio is never going to be the highest performer in any given year, but it is also much less likely to collapse. Consistency and protection against disaster are worth more over the long term than chasing the highest possible return in any single year. Risk management is not about avoiding risk entirely. It is about taking the right risks for your situation and avoiding the unnecessary ones. The unnecessary risks are the ones that come from lack of information, emotional decisions, or trying to get rich fast by putting everything into a single bet. The right risks are the calculated, diversified, long-term ones that most successful investors use. Risk is not the enemy, recklessness is, and the difference between the two is knowledge, patience, and a clear plan that you stick to even when it gets uncomfortable. Debt is one of the biggest obstacles between people and their ability to invest. When a large portion of your income is going toward high-interest debt every month, there is very little left to put to work for your future. The math is simple and brutal. If you are paying 20% interest on credit card debt, you need your investments to earn more than 20% just to break even. The stock market does not reliably deliver that. So for most people, paying off high-interest debt quickly is itself a form of investing. Every dollar of high-interest debt you eliminate is a guaranteed return equal to the interest rate you are paying. That does not mean you should wait until all debt is paid off before you start investing. Low-interest debt, like a mortgage or a student loan with a reasonable rate, does not necessarily need to be paid off early before you begin investing. The math often works in your favor to invest while carrying low-interest debt because your expected investment returns can exceed the interest you are paying. The key is to understand the cost of each type of debt you hold and make intentional decisions based on those numbers rather than on emotion or general advice that does not account for your specific situation. Creating a plan to attack debt while also beginning to invest, even in small amounts, serves two purposes. It builds the habit of investing before you have a lot of money, which makes the habit stronger by the time more money is available. And it prevents the feeling of being stuck in a cycle where you are waiting to start your financial life until some future point when everything is perfectly clean. That point often never comes. Life keeps adding new expenses and new challenges. The people who wait for perfect conditions end up waiting forever. The people who start imperfectly tend to finish well. Emergency savings and investing are connected in a way that many people do not understand. Without an emergency fund, any unexpected expense forces you to stop investing or even pull money out of your investment account, often at the worst possible time. Having 3 to 6 months of basic expenses saved in an accessible account acts as a financial cushion that protects your long-term investments from being disrupted by short-term surprises. Building this cushion and building your investment habit at the same time is not always easy, but it is the approach that creates the most stability over time. The order in which you tackle financial priorities matters. Most financial guides suggest getting any employer match first, then building a small emergency fund, then aggressively paying down high-interest debt, then returning to investing and growing the emergency fund further. This is not the only right sequence, but it is a logical one that protects you from the most common pitfalls. Whatever order you choose, the most important thing is that you have a plan and that you follow it consistently, rather than reacting to each new crisis as if starting from scratch. Income is the engine that makes everything else possible. You can be the world's best budgeter, but if your income is too low, there is only so much you can do on the expense side. At some point, growing your income becomes the most important financial move you can make. This does not necessarily mean getting a second job and burning yourself out. It means thinking strategically about how to increase what you earn over time through skills, value, and positioning. People who grow their income consistently over the years and keep their lifestyle from growing at the same rate end up accumulating wealth quickly. Learning a high-value skill is one of the most direct ways to increase your income. Skills that are in demand and relatively difficult to acquire command higher pay in the marketplace. This is true whether you work for someone else or for yourself. The investment in learning, even if it takes time and costs money upfront, can pay returns that dwarf anything the stock market can offer in the short term. A skill that increases your annual income by $10,000 is like having an asset that generates $10,000 a year indefinitely. That is an extraordinarily powerful return. The digital economy has created opportunities to earn income in ways that did not exist a generation ago. Freelance work, online services, teaching skills to others, creating content, and building small digital products are all real ways that regular people are generating additional income today. None of them require a large upfront investment. Many can be started in the evenings and on weekends without quitting a day job. The goal is not to build an empire overnight. The goal is to create an additional stream of income, however small, that you can direct entirely toward investing and building your future. Passive income is a phrase that gets thrown around constantly in financial media, and it can mean many different things. True passive income, the kind that requires almost no ongoing effort, usually requires a significant upfront investment of money, time, or both. Dividend-paying stocks, rental income from real estate, and interest from bonds are examples of investments that generate income over time after the initial work of acquiring them. These are not get-rich-quick schemes. They are long-term strategies that work better the earlier you start and the longer you stay committed to building them up. The relationship between your active income, your spending habits, and your investment behavior determines your financial trajectory. It is not any one of these things alone. Someone who earns a lot but spends everything will end up in the same place as someone who earns little and spends everything. Someone who earns a modest income but consistently invests a portion of it and grows their skills over time will likely end up in a very different place. Financial security is not about how much you make, it is about the gap between what you make and what you spend, and what you do with that gap. Time is the most powerful force in investing, and most people only understand this in theory. They know it intellectually, but they do not feel it. The reason is that compound growth is slow at the beginning and breathtaking at the end. The early years of investing can feel discouraging because the numbers are small and the growth seems trivial. But those early years are setting up the foundation for the exponential growth that comes later. If you stop contributing during the early phase because it does not feel like it is working, you miss the entire point. Patience here is not passive, it is strategic. Look at two people. One starts investing $200 a month at age 25 and stops contributing at age 35, then just lets the money sit. The other starts at age 35 and contributes $200 a month consistently until age 65. Because of compound growth and the extra time those early years provide, the person who stopped contributing earlier often ends up with more money at retirement. That is not intuitive, but it is the math. Those 10 early years of contribution and growth can be worth more than 30 years of contribution that start later. This is the power of time in the market. Starting early does not mean being reckless. It means being consistent with something reasonable as soon as possible. The person who invests $50 a month starting today is ahead of the person who invests $500 a month starting in 5 years, in some scenarios. The specific numbers depend on rates of return and timing, but the principle is clear. Time in the market, combined with regular contributions, is one of the most reliable paths to financial security available to ordinary people. The question is never whether you should start, it is only whether you will. Looking at historical data, the stock market has never permanently failed to recover from a downturn over a long time horizon. Every recession, every crash, every period of fear and uncertainty has eventually been followed by growth that exceeded the previous peak. This does not guarantee future results in a legal sense, but it does provide a historical context for why long-term investors who stay patient tend to do well. The people who lose in the market are usually the ones who bought when optimism was high and sold when fear took over, which is the exact opposite of what rational strategy suggests. If you are in your 40s or 50s and reading this, please do not let the word late stop you from starting. Yes, someone who started at 25 has a head start, but the person who starts at 45 and invests consistently for 20 years still ends up in a dramatically better position than the person who never starts at all. 20 years of compound growth is still extraordinary, and you have something that younger investors often lack, which is the earned wisdom to be patient and the life experience to keep things in perspective. Start where you are. Use what you have. Do what you can. Let us talk about the habits that separate people who build wealth from people who dream about it. The difference is almost never intelligence or opportunity. It is the small, repeated behaviors that compound over years just like money does. The habit of tracking your spending, the habit of investing automatically, the habit of learning something about money every week, the habit of reviewing your financial situation every month and adjusting. These small actions feel insignificant individually, but strung together over years, they create a foundation that is difficult to break. Reading and learning about personal finance is a habit that pays dividends in a direct and measurable way. The more you understand how money works, the better decisions you make. And better decisions, repeated over time, create dramatically different outcomes. You do not need to read complex economic theory or understand every instrument in the financial market. You need to understand the basics deeply and apply them consistently. A handful of solid principles applied reliably will outperform a dozen complex strategies that you partially understand and apply inconsistently. The people around you affect your financial habits more than most people want to admit. Spending time with people who prioritize financial stability and growth tends to reinforce those values in yourself. Spending most of your time in environments where money is treated carelessly or where appearing wealthy matters more than actually being financially sound creates pressure that works against your goals. This is not about cutting people out of your life. It is about being intentional regarding where you spend your attention and whose beliefs about money you absorb as normal. Celebrating small wins on the financial journey matters more than most people give it credit for. When you reach your first $1,000 in savings, that is a milestone worth acknowledging. When you pay off a credit card, that is real progress. When your investment account shows its first significant gain, you have evidence that the strategy is working. These moments of recognition keep motivation alive during the long stretches where progress is less visible. Wealth is built in years and decades, not weeks and months. Finding ways to stay engaged and encouraged during the process is part of the strategy, not separate from it. The final habit that ties everything together is review and adjustment. Your financial situation will change over time. Your income will hopefully grow. Your goals will evolve. Market conditions will shift. The best investors are not the ones who set a plan once and never look at it again. They are the ones who check in regularly, make thoughtful adjustments, and stay aligned between where their money is going and where they want their life to go. This is not complicated. It is a monthly or quarterly conversation with yourself about what is working and what needs to change. That conversation, held consistently, is worth more than any single financial product you could buy. There is a version of your financial future that is better than where you are right now. Not because of luck, not because the economy suddenly becomes generous, but because you decided to understand how money works and then acted on that understanding with consistency. The path from where you are to where you want to be is not a straight line. It will have setbacks. It will have months where nothing seems to be working. It will have moments where giving up feels easier than continuing. But every person who has ever built financial security from modest beginnings has walked that same road. And most of them will tell you the same thing. The hardest part was starting. You do not need perfect conditions to begin. You need a decision and an action that follows it quickly enough that fear does not have time to talk you out of it. Open the account, transfer the first $10, set up the automatic contribution. These small acts are not just financial moves. They are statements about who you are and what kind of future you are building. Each one makes the next one easier. Each one chips away at the story that says this is not possible for you, because it is possible for you. It always was. The information was just not in the right hands until now. The people who are quietly building wealth right now are not extraordinary. They are consistent, they are patient, they understand enough to act without needing to understand everything. They have learned to tolerate the discomfort of delayed gratification because they have seen, even in small ways, that it works, and now they cannot imagine going back to the way things were before when every paycheck disappeared and nothing was growing. That feeling of watching your money work while you sleep is available to you. It starts with the first step, and the first step is available right now. Every financial concept in this video is learnable, every strategy is available to you, every tool mentioned is accessible. There are no secrets here, only knowledge that has not been in the right place at the right time for most people. The system was not designed to teach regular people how to build wealth. It was designed to move money from people who do not understand it to people who do. Understanding it changes which side of that equation you are on, and once you are on the right side, you stay there, not because the game gets easier, but because you get better at it. This is just the beginning of what is possible when you commit to learning and applying what you know. The investors who started with nothing and built lasting security did not do it with perfect information or perfect timing. They did it with consistent action over time. If you take one thing from everything you heard today, let it be this. Start now. Start small. Stay in. Adjust as you learn. And never let someone else's definition of what is possible for a person like you stop you from finding out what is actually true, because the truth is better than most people expect.